Welcome back to Withum's video series, The Alternative Route. Here with me today is Josh Pagano, Financial Services Tax Partner and Digital Assets Team Leader from Withum, and Duke Kim, Director of Sales at Securitized Fund Services. Josh and Duke, thank you both for joining us today.
Thanks for having us.
Thank you so much, Colleen.
Okay, so there's been a lot of activity lately in the digital asset space, and today we're going to talk a little bit about tokenization and digital asset operational risks. So Duke, you've been involved in the crypto ecosystem for quite some time, specifically in data and technology. So what do asset managers need from fund administration for digital assets, and what is different from traditional asset classes?
Sure. I think it really starts at the asset itself. So when you think about crypto assets such as Bitcoin, Ethereum, and tokenized real-world assets, again, starting at the asset itself, there are simple things like decimal precision, as well as security master or identification of those specific digital assets that really differ from equity, fixed income, or currencies and commodities. Beyond that, then it goes into pipes and plumbing. You really think about where you're getting your data from a fund administrator's perspective, just because the assets themselves don't trade on what we'll call traditional exchanges or marketplaces. And then beyond that, when it comes down to doing the actual fund accounting work, it really comes down to understanding, or a fund administrator understanding specifically the activities involved here, as well as then how to account for them properly.
That makes sense. And Josh, what do you see from the tax and audit perspective?
Sure, yeah. I mean, to Duke's point, the better and more clear data we have, the more we can do with it. So I'm specifically on the tax side, we need to have all of the data broken out and have it to know where that transaction came from and what it's associated with. So for example, gas fees, transaction fees, we want to know what token or coin that is associated with. So if we have to capitalize those fees, or if we're doing something with it, the better data we have, is obviously key, especially when tax code is not as clear when it comes to digital assets. If you want to take a certain position or look into something, the better data we have is obviously key. As far as auditing goes, ownership verification is a big one. There's certain wallets that you can link up with an API connection and have a little more detail when you're auditing, and have that linked up directly. And then there's other ones where maybe it's a newer exchange or something that isn't linked up. So the auditors might have to have the owner of the wallet move a nominal amount from one wallet to another. That's a big one. Valuation is something that's a lot different than traditional assets. It's not exactly on a public exchange, even though it's publicly traded. A valuation policy needs to be created from early on.
Sounds like the devil's in the details.
Yep.
So let's switch the discussion to tokenization. Duke, for our listeners who aren't too familiar, can you give us a brief overview of how tokenization works and what the nuances involved with it are?
Sure. Tokenization has been, I guess just to take a step back first, tokenization has been a buzzword from really the last crypto cycle to this one now. And a lot of people are talking about it, and it can sound somewhat mystical, given it's, again, a buzzword in the world of crypto, which, again, is a departure from your traditional asset classes and traditional asset managers. But really, the process itself isn't that frightening. It's simply the process of turning a real world asset. In this case, it could be something like a financial instrument. You can talk about tokenizing art, apartments and real estate, things of that nature. But specifically for our conversation, we'll think about real world financial assets, whether that be equity, shares, LP shares in a hedge fund, or commodity. So again, the tokenization, again, is turning that real world asset into a digital representation on a blockchain. So it sounds kind of scary, but really it's simply a digital receipt that represents a one-for-one ownership and receipt to a real-world asset there. The real nuance is, or the real trick to this, and this is where Josh and his team come in here, is really ensuring that a single token, a single entity on a blockchain, represents a single share or a unit of that real-world asset.
Yeah, good point, Duke. So I can just kind of chime in from audit and tax perspective. So from a tax perspective, this could obviously change depending on what you're tokenizing. So if you're tokenizing a security or an asset, it could be treated as a security for tax purposes. If you are tokenizing artwork, it could be considered a collectible. So you need to talk to your tax advisor and see exactly what you're holding, because it could be representative of what the item actually is in real life. From an audit perspective, there's a couple things that you want to look at as well. Establishing who actually owns this and going through the AML KYC procedures and seeing, who actually has the ownership of this item, especially from an audit perspective, is a big deal. Valuation and pricing, depending on what the asset is, could wildly change, whether it's real estate or artwork. And I think liquidity is another thing. Is just how often can these tokens be traded? Do making sure do you have to sell it to somebody else, or do you have to sell a piece of the actual asset that's being tokenized? So just some things to consider that are usually brought up in the structuring and the beginning of the fund. That's all decided before you get into it.
Very interesting. So last question for both of you, with the caveat that this isn't financial advice, but where do you see the digital asset market going in the next couple of years?
Wow. So with the caveat that it's not financial advice, the joke would be, up only across most of the assets, and that's whether the assets are digitally native, such as Bitcoin, Ethereum, and Solana, but also simply the ecosystem overall. So where I see a large majority of the activity and the interest from an investor's perspective or for an institutional perspective is the continued tokenization of real world assets, right? So we have players like Securitize that are tokenizing money market funds, bringing them on chain to unlock, as Josh mentioned, liquidity, transparency, as well as capital access for investors. And we're going to continue to see that type of activity really grow and drive institutional adoption of the assets. So the punchline for me has been continued tokenization of real world financial assets.
Yeah, I agree with Duke. Just to add a couple things, obviously outside of the US, there's been a big uptick in the crypto marketplace, especially in like the Asian marketplace. I think with the current administration, that the goal is to bring a lot of this back to the US and, make the US the main hub for cryptocurrency. So, I don't really pay attention too much to individual coins and, all these altcoins and meme coins. I mean, a lot of those aren't going to survive forever, but the blockchain technology is here to stay. The uses that we have for it, new things like tokenization that are coming up, and a lot of exciting use cases for the blockchain technology itself. I don't see it going away. Fiat is another big item that a lot of countries are looking at. So I think depending on what happens individually, who knows? But I think the crypto marketplace is here to stay.
Well, certainly exciting times are ahead. Thank you both for joining us today with this valuable insight, and stay tuned for our next episode of The Alternative Route.